Liquidity determines whether a bad market is an inconvenience or a personal crisis. In unstable periods, returns matter less than survival, and survival depends on cash flow, reserves, position size, and the ability to avoid forced decisions. So, if you want to stay stable in bad times, stop thinking like a spectator and start thinking like a risk manager. Your goal is not to look fearless. Your goal is to stay operational when conditions get hostile. Let's get precise about what stability actually means. Stability is not the absence of volatility. Stability is the ability to absorb volatility without breaking your financial structure. That means your bills still get paid, your investment plan remains intact, your decision-making does not collapse under stress, and your future options do not disappear because the environment turned against you. Most people think bad times are mainly about markets going down. That is too narrow. Bad times are any period where liquidity tightens, income becomes uncertain, asset prices become unstable, borrowing gets more expensive, and confidence vanishes faster than reality. In those periods, the difference between strong investors and fragile investors is not intelligence, it is structure. You need to understand how the machine works. Markets do not fall apart randomly. Prices move because expected future cash flows are constantly being repriced through interest rates, liquidity conditions, volatility, and positioning. When central bank policy tightens or credit conditions deteriorate, capital becomes more selective. That changes how stocks, bonds, real estate, and even private businesses get valued. Momentum weakens, leverage becomes more dangerous, weak hands exit, and optimism stops masking bad balance sheets. That is the operating mechanism. The financial equivalent of a biological mechanism is stress response. In a healthy system, pressure triggers adaptation. In a weak system, pressure triggers failure. Your finances work the same way. If your reserves are thin, your fixed costs are heavy, and your portfolio is oversized relative to your life, then bad times expose that immediately. If your balance sheet is resilient, the same conditions become difficult but manageable. That is why the first financial rule is simple. Protect liquidity before you protect appearances. You do not need to look fully invested. You need to be able to function. In good times, people underestimate cash because it looks passive. In bad times, cash becomes decision-making power. It keeps you from liquidating productive assets at poor prices. It buys time if income drops. It reduces the pressure to borrow expensively. And it gives you the psychological space to think clearly while others are reacting emotionally. Most investors misunderstand this because they evaluate liquidity only by its visible return, not by the mistakes it prevents. But bad times are full of decisions that feel urgent and are actually expensive. Liquidity filters those decisions. So apply that rule practically. If your income is stable, you still keep a meaningful reserve because stability can change quickly. If your income is variable, cyclical, commission-based, or tied to a weak economy, you keep more. If markets are calm and risk assets are rising, you do not use that as an excuse to minimize reserves. You maintain the buffer before the environment demands it. If markets fall sharply and your income remains intact, you do not need to sell quality assets just to create breathing room. If income weakens at the same time markets fall, your reserve becomes the difference between adapting and unraveling. That is the point. Stability begins before trouble, not during it. The second rule is to keep fixed costs lower than your ego wants them to be. This is one of the least glamorous rules and one of the most powerful. In bad times, the market does not care how much your lifestyle used to signal success. Heavy fixed costs reduce flexibility, increase the income you must earn just to remain stable, and turn uncertainty into pressure much faster. A large rent payment, expensive financing, high insurance obligations, recurring upgrades, subscriptions, and other manageable commitments can feel harmless in a strong economy. But once income drops or volatility rises, those commitments stop being convenient and start becoming structural weakness. You do not stay stable in bad times by earning your way out every month. You stay stable by not building a life that requires perfect conditions. This matters strategically because every fixed obligation changes your break-even point. The higher your break-even point, the less room you have to absorb shocks, and the more likely you are to make rushed decisions. If your monthly structure is lean, you can adjust. If it is rigid, you are forced. Most people misunderstand this because they measure affordability by current income instead of resilience under stress. A purchase is not truly affordable because you can handle it today. It is affordable if it still leaves you liquid, investable, and adaptable when the environment worsens. So when income rises, your first reaction is not lifestyle expansion. It is structural reinforcement. You increase savings, reduce expensive debt, strengthen reserves, and widen the gap between what you earn and what you need. If bad times arrive later, that gap becomes your stability margin. If your fixed costs are already too high, you correct them before the market or economy forces you to. You do not wait for stress to teach you what flexibility costs. The third rule is to separate money by time horizon with zero ambiguity. This rule prevents many bad time mistakes before they happen. Short-term money should not be placed in assets that can fall sharply if you may need that capital soon. Long-term capital should not be judged by next month's volatility. Tactical capital should have explicit risk limits. When you mix these categories, you create confusion, and confusion becomes panic when conditions worsen. If you need money in 12 months, you do not expose it to major drawdown risk and call it conviction. If you are investing for 10 years, you do not let 1 quarter of volatility rewrite your plan. The strategic reason is straightforward. Bad times compress decision windows. If your capital is mismatched to your obligations, you lose the luxury of patience. That is how good assets become bad experiences. Most investors misunderstand this because they talk in slogans like long-term or buy the dip, without checking whether their own money can actually behave long-term under pressure. You need to define the time frame first, then choose the asset and size accordingly. If the market moves down 20% and the capital was truly long duration, you evaluate opportunity. If the capital was short duration, then the problem was your original allocation, not the market alone. The fourth rule is that position size matters more in bad times than conviction ever will. Conviction feels intelligent in calm markets. Position size is what decides whether you remain solvent and emotionally functional when volatility expands. No single idea should be large enough to damage your ability to continue operating. That includes stocks, crypto, real estate exposure, private deals, concentrated sector bets, and anything else that depends on one fragile thesis. In good times, concentration can look like brilliance. In bad times, it often becomes a lesson in asymmetry. A large loss requires a disproportionately large recovery. That is not pessimism. That is arithmetic. So if the market becomes euphoric and a position starts running, you do not automatically increase size because recent gains feel validating. You check exposure. You ask whether the position has grown beyond its intended risk budget. You decide whether to trim, rebalance, or leave it if still within limits. If the market drops and a position declines sharply, you do not average down just because it looks cheaper. You ask what changed in liquidity, earnings expectations, or the balance sheet. You ask whether the lower price represents better value or higher risk. If your answer depends only on how far it has fallen, you are not analyzing. You are anchoring. The fifth rule is to distinguish discomfort from danger. This is where mature financial behavior begins. Bad times create both. Discomfort is often normal volatility, negative headlines, slower growth, or temporary uncertainty. Danger is a deteriorating balance sheet, collapsing liquidity, rising debt pressure, or forced dependency on favorable market timing. If you cannot tell the difference, you will either panic during normal pain or stay passive during real damage. Both errors are expensive. This is where most people stop, but this is the advanced level. Once you can protect liquidity, control fixed costs, separate time horizons, and size positions correctly, you need to start reading second-order effects. A rate increase is not just higher borrowing cost. It changes mortgage demand, refinancing activity, startup funding, credit spreads, equity multiples, consumer behavior, and bankruptcy probability for weak borrowers. A rising unemployment trend does not only threaten labor income, it also changes spending patterns, loan performance, rent pressure, and business earnings. A market rally led by a narrow group of assets can feel strong while actually signaling fragile breadth. A falling asset can look cheaper while becoming less safe if liquidity is evaporating and forced sellers are entering. In bad times, first-order thinking is not enough. You also need to understand correlation breakdown. In calm periods, diversification looks simple. Different assets often move differently, and people begin to trust their portfolio design too much. In stress periods, fear and liquidity can dominate everything. Assets that looked diversified on paper can start moving together because participants are selling what they can, not just what they want to. That matters because many investors assume their portfolio will protect them when their true protection was supposed to come from liquidity and prudent size, not from optimistic correlation assumptions. Then there is liquidity trap risk. A lower price does not automatically mean better opportunity. Sometimes it means the market is signaling structural weakness, funding pressure, or a crowd that cannot exit cleanly. If you buy purely because something fell, without understanding why it fell, you can turn a disciplined process into a reflex. And then bankruptcy mathematics comes in. A 50% drawdown requires a 100% gain to recover. Once debt service pressure rises while income falls and asset values decline, the margin for error shrinks quickly. This is why stable people often look conservative from the outside. They are not underplaying opportunity, they are protecting future participation. Behaviorally, bad times punish the same weaknesses repeatedly. Overconfidence makes you think concentration equals skill. Chasing trends makes you buy after easy conditions are already gone. Poor risk control makes one mistake erase a year of discipline. Ignoring time frames makes you hold the wrong asset for the wrong reason. You do not solve these by trying to feel stronger. You solve them by building rules that function even when you feel weak. So let's make this operational. Suppose the market drops 15% in 6 weeks. You do not react with a headline-based move. First, you check your own structure. Is your emergency reserve intact? Is your income still stable? Are your obligations still manageable without using portfolio assets? Then you check the market environment. Is this valuation compression, earnings deterioration, liquidity stress, or a solvency event? If your long-term plan is still intact and your personal structure is sound, you continue scheduled contributions and possibly rebalance if allocations have moved far enough from target. If your reserve is weak or your income is unstable, you do not pretend the real issue is only market volatility. You strengthen the foundation first. Suppose the market rallies sharply during a fragile economy. You do not mistake price recovery for structural healing. You ask what is driving the move. Is liquidity improving? Are earnings stabilizing? Is breadth broadening? Or is this mainly positioning and short covering? If the answer is unclear, you do not suddenly abandon discipline because price looks better. You keep sizing rational. You keep reserves appropriate. You do not let temporary relief rewrite permanent rules. Suppose your income weakens while markets are still unstable. Your reaction is not ego, it is triage. You slow non-essential investment contributions if necessary, preserve core liquidity, cut discretionary spending, and avoid taking new risk just to make it back. That last mistake destroys a lot of people. They try to solve structural weakness with speculative urgency. You do the opposite. You reduce fragility first, then rebuild optionality, then resume risk-taking from a stronger base. Now let's talk about process, because rules only work if you can execute them consistently. You practice stability before bad times by writing down your system. Define your reserve target. Define your maximum exposure to any one asset or theme. Define how much of your income is committed to fixed obligations. Define what counts as short-term money and what counts as long-term capital. Define what would make you rebalance, reduce exposure, or stop adding risk. If it only exists in your head, it will change with your mood. That is not a rule. That is a preference. Journal meaningful decisions. When you increase a recurring expense, write down what it does to your savings rate and flexibility. When you buy an asset, write down the thesis, time frame, size, and exit logic. When you trim or rebalance, write down whether you are reacting to fundamentals, valuation, risk concentration, or pure emotion. Then reverse test the decision. Ask what would have to happen for this move to hurt you badly. Ask whether that risk is genuinely remote or merely inconvenient to think about. That practice sharpens judgment because it forces you to confront the cost of being wrong before the market charges you for it. Simulation matters too. Run stress tests on your life and your portfolio. What happens if your income drops 20%? What happens if rates stay high for longer than expected? What happens if your largest asset falls 30%? What happens if two diversifying assets decline together? What happens if an unexpected expense hits during a weak market? These are not pessimistic exercises. They are rehearsals for staying composed under pressure. To maintain the skill, build evaluation loops. Review cash flow monthly. Review allocation quarterly. Review fixed cost creep every 90 days. Track metrics that matter: months of liquidity, savings rate, debt service ratio, portfolio concentration, percentage of income committed before payday, and error frequency. When something goes wrong, do not only measure the financial loss, measure the process failure. Were you too large, too early, too rigid, too optimistic about liquidity, too casual about time horizon, or too dependent on favorable conditions? That is where the real correction lives. You also strengthen stability by combining tools rather than relying on one lens. Use valuation to understand what price implies. Use macroeconomics to understand the conditions acting on that price. Use technical analysis to observe how positioning and behavior are unfolding in real time. Use risk management to ensure even a good thesis cannot damage your life through bad execution. Valuation without macro can trap you in assets that remain cheap for valid reasons. Macro without technicals can make you early and ineffective. Technicals without risk management can turn pattern recognition into impulsive trading. Risk management without a real thesis can make you safe but stagnant. Integration is what turns information into durable action. Then test your rules under controlled pressure. Use paper trades for tactical ideas before committing real money. Use small-scale real positions if you need to observe how your emotions distort judgment. Do pre-trade risk analysis before any move outside your standard plan. Stress test your personal budget when life feels calm, not after conditions deteriorate. The goal is not perfection. The goal is to become stable enough that bad times do not force you into low-quality decisions. So if you want the clean answer, the financial rules that keep you stable in bad times are not complicated, but they are demanding. Protect liquidity before appearances. Keep fixed costs lower than your ego prefers. Separate money by time horizon. Respect position size more than conviction. Distinguish discomfort from danger. Read second-order effects instead of only headlines. Test your system before the environment tests it for you. Stability is not created by a good month or one smart trade. It is created by rules that keep functioning when conditions stop cooperating. And here is the detail worth replaying because the whole logic quietly depends on it. Bad times do not usually destroy people through one dramatic mistake. They expose the everyday decisions that left no margin for error. Once you see that clearly, you stop asking only whether a decision works in a good environment. You start asking the question that actually keeps you stable. What happens to this decision when the world becomes less forgiving?